startups are here to tackle big problems. Climate change is probably by far the biggest problem we are facing. We don't want people to think of Africa as just a victim of climate change, but also as an actor who can be a significant part of the solution to this challenge. The impact is a result of the commercial scale.
Today on Impact Talk, we are heading to Africa to explore how innovation is helping communities adapt to climate change. My guest is Maxime Bayen, operating partner at Catalyst Fund, an early-stage VC fund backing mission-driven founders building climate-resilient solutions across Africa. Maxime leads portfolio support and value creation for more than 20 startups, guiding them on strategy, growth, and fundraising. He's also the co-founder of Africa, the Big Deal, the leading insights platform tracking startup funding across the continent.
There is no silver bullet when it comes to venture building. You need to allocate time, money, and people.
For VCs who want to enter the climate tech space, what advice would you give?
In climate tech, it's not going to be just software. We will not solve climate change and help people adapt to climate change with just mobile apps.
Maxime, welcome to Impact Talk.
Thank you.
So before we dive into your work at Catalyst Fund, I know that you've worked at the intersection of startups, investments, and climate for over a decade. So I want to ask you, how did your journey lead you to focus on climate change? And what specific moment or experience made this mission personal to you?
Thanks a lot. That's a great question. To understand this, I think it's important to go back a little bit. So sorry for taking you back in time, but all this started many years ago when I started my career. One of my first job was actually doing advisory and support for a mobile operator in Kabul, Afghanistan. And there I had the opportunity, so that was back in 2008, I had the opportunity to witness firsthand how private economy can be the strongest driver of economic development. Why? Because I arrived in a city where a lot of things were not working. A lot of infrastructure was not working. You didn't have electricity the entire day. Roads were not paved except a few roads in Kabul and so on and so forth. But there were a couple of things that were working, like mobile operators, like telco, and that were things that were basically driven by private companies, right? So yes, you didn't have roads and necessarily good electricity infrastructure, but you had 4 mobile operators selling SIM cards, deploying towers across the countries. At that point, they were also experimenting to roll out mobile money. And so from that point onward, I followed this sort of line throughout my career, which was to work at the intersection between private economy and economic development. This, further down the line, took me to work with startups, and then specifically startups in Africa. Why? Because if you think about it, right now, investing $1 in an entrepreneur in Tanzania is probably one of the biggest lever you can have on driving economic development, in Tanzania, but globally probably. We know that this dollar will be used to create jobs, will be used to drive impact locally, and with a stronger efficiency than any other typical aid-driven support. So that's why I've been now focusing on this. The topic of climate came a little bit later. Many years ago, I had already the opportunity to work with startups that were already in the climate space, but it really was exacerbated, I would say, more at a personal level when I had kids, when we had kids, who are now aged 12, 9, and 6. And I realized that I wanted to try in my humble level to contribute and leave them a planet that is, let's say, livable as much as possible. And also to aim to be on the right side of history when it comes to climate change. So that's what drove me to focus more on this topic, And also realizing that, many years ago when I started working with startups and discovering the space of venture capital and so on, one big thing that stuck to me was the fact that startups are here to tackle big problems. And ideally, the bigger the problem, the bigger the opportunity. And you can search throughout right now, but climate change is probably by far the biggest problem we are facing altogether. And so I believe that startups can contribute to tackle this problem. They will not solve it alone, that's for sure. But I think using some of the best brains we have to develop solutions in that space can definitely go a long way. So that's why startups in Africa, and that's why climate change as a sector.
Amazing. Now, if we link that to your work at Catalyst Fund, because what I found very interesting in your investment thesis is that you focus explicitly on climate adaptation and resilience solutions in Africa. What makes this focus strategically important for the continent, and how do you convince investors that adaptation can also be a strong financial opportunity?
This is a great point. So if we look back again a little bit at climate change and what caused it, Africa was definitely not a continent that contributed to the problem. Global emission of CO2 that come from Africa are just about 2 to 3%. Yet it's the continent that is the most affected by the negative effect of climate change. If you think droughts, if you think water scarcity, if you think floodings, if you think extreme weather events, storms, and so on, by far Africa is the most affected. And even by and there are some things that we don't necessarily think are linked to climate change, but unfortunately are. Especially in the health space, right? If you take disease like malaria, for instance, who are vector-borne, so basically borne by mosquitoes in this case, they are significantly worsened by climate change. Why? Because if you take countries around the equator, let's say Kenya, Tanzania, Nigeria, and so on, you basically just half a degree change of average temperature drives 100% increase of the mosquito population. And right now at the pace we are at, every decade there is about 0.3 degrees increase of average temperatures in this country. So that means every 10, 15 years the mosquito population is doubling, and therefore the number of malaria cases. So this is not in the future here, we're not talking 20, 30, 40 years from now, we're talking today. The impact is there in many countries across Africa. So that's why we believe in terms of sequence, the need to focus first on adaptation and resilience is more urgent than the need to mitigate the climate change. But of course, both go in parallel, and we need to continue the effort on both sides. So in our mission, we focus on climate adaptation and resilience, but we also keep an eye on mitigation and how we can reduce CO2, or more importantly, how we can support Africa in embarking in a way that is decarbonated, in an economic development path that is decarbonated. I think this is really, really key to do both in parallel. Now, here we talked about the challenge and why climate adaptation and resilience is key, but there's also an opportunity part that is really important. We don't want people to think of Africa as just a victim of climate change, but also as an actor who can be a significant part of the solution to this challenge. If you think again of Africa as a continent, it's a huge arable land. It's huge demographic amount of talent across the continent is significant. There's also abundant access to renewable energy. If you think about it, solar energy, wind energy, even hydraulic energy. So it's really a huge untapped resource that a number of other countries and other regions don't necessarily have access to. And so in that sense, we believe Africa can be part of the solution. There was a recent McKinsey report talking about climate adaptation and resilience tech globally, and the estimate is that this sector, so climate adaptation and resilience tech, is a $1 trillion opportunity by 2030. That's the opportunity we want to put Africa on, and that's really what we're chasing. So it's both the urgency to tackle this problem because it's the earliest one in terms of sequence, but also a strong opportunity that we believe in. Yeah.
So I guess balancing in your conversation the challenges, but also at the same time, highlighting the huge opportunities for the continent, and also at the same time a financial opportunity for.
Yes, definitely, and we believe there can be a financial opportunity. Our fund is, yes, impact focused, but also a commercial fund. We are a venture capital fund. We have LPs who expect us to drive returns from this fund. And all the startups we invest in have economic models. A number of them are actually already profitable. They're all, we have made 24 investments so far. All of them are generating revenue, although they are very early stage. It's pre-seed companies when we invest. So we are talking about, models that, yes, are tackling a climate adaptation resilience problem, but are also commercial. And in our view, the impact is a result of the commercial scale. The more the commercial scale, the more the impact. I'll give you one example here. A startup called Medicare in Tanzania. They're in the healthcare, primary healthcare access. Again, back to the point I mentioned earlier on health being affected by climate change. This startup was started, I think, 3 or 4 years ago by 2 doctors, Elvis and Desiree. Initially, they were, doctors. General practitioner doctors, and with the aim to support as many patients as they could. But they quickly realized that maybe there was a solution for them to sort of using technology to have a much bigger impact. And instead of just treating patients themselves, building a much bigger platform to multiply their effect. And so that's why they started Medicare, which is an hybrid model with both telemedicine access and a number of physical clinics that they are rolling out through the country, starting with Dar es Salaam, and now able to treat 3,000 patients per month. And I was meeting with Elvis a couple of days ago, and he was telling me that alone it would be impossible for him to treat so many patients each month. So that's what we're talking about: using technology and innovation to multiply the impact that you can have, and having an economic model to sustain it. And hopefully, Medicare in a couple of years from now will be treating millions of patients, just initially driven by 2 doctors. Right, so that's the kind of impact we want to see, and as you can see there, the impact is a result of the economic scalability of the model.
Yeah, I always mention that in my conversation, the link in the business model between the finance, the economic aspect and the impact. Normally, the more you generate revenues, the more impact you create on the ground.
Ideally,
so, yeah. I'm very curious to learn more about Catalyst Fund because when I came across your fund, I was number one super excited to see a fund dedicated to climate, plus having the focus on pre-seed, which is one of the main issue we see in the startup ecosystem funding of pre-seed. I want to ask you, it has evolved over time because it was initially an accelerator and grant-based model, and became a VC fund and venture studio. What triggered this evolution, and what have you learned along the way?
Sure. So Catalyst Fund was started back in 2016. Initially, it was a program from a firm called BFA Global that then, back then, was basically awarding grant funding to startups, mainly in the sector of financial inclusion across Africa, Latin America, and South Asia. the model of supporting startups with venture building. I mean, you mentioned venture studio. The exact term is more venture building that we do. That model was started from the very beginning by my partner in the fund, Maëlys, who is the real initiator and the real entrepreneur at the beginning of Catalyst Fund. This model already existed, so we were always providing grant together with venture building. Why? Because we invest in very early stage companies that are somewhere between 1 and 3 years old, and we know that there's a number of challenges, a number of pitfalls that entrepreneurs at early stage are facing, and we felt that building a platform to help them tackle some of these problems in their product, their tech, their sales strategy, their marketing strategy, and so on would go a long way. So that's what we have been doing. We've done that with over 60 companies since 2016. But indeed, as you mentioned, it was grant funded, which means that we were trying to find donors and then providing these grants to the entrepreneurs, supporting them for 6 to 12 months. And after that, basically they would be part of the portfolio, but the support we were able to give them beyond that was a little bit more limited. We changed the model for a number of reasons. One is that we wanted the model to be more sustainable, so not just based on grants that we were or not able to get access to. So that was one strong belief. And the other reason was also to build a model where we had an opportunity to support them even beyond the venture building time. So right now we're still providing venture building. When we write a pre-seed check, it always comes with venture building embedded in it. And that's support that's done by the dedicated team. We spend somewhere between 300 and 500 hours on each company. But beyond that, we can support them. Why? Because they are part of our investments. We are shareholders in the company. We're in their cap table, and so we can continue to support them in the long run over a period of 5, 6, 7, 8, 9, 10 years. So that's really one of the reasons we changed the model. It actually also came from the entrepreneurs themselves. When it was grant funded, some entrepreneurs came to us and say, it's been great to work with Catalyst Fund for this past year, but we would love to actually have you on the cap table and count you among our investors because you were some of the earliest believer in what we were doing, and so we would love to continue the journey with you. So that's also why we decided to change the model. And now, yes, so we mix venture capital with venture building at early stage, at pre-seed. And then we can also follow on invest at seed and Series A. So we're here for the long run, and I think this is a very important point, especially in climate tech, is to be able to support these companies on the long term. Most very early stage VCs would typically just do, and especially accelerator models would typically just do one check at the beginning and then let it for other VCs to continue the support. We aim to be even more closer to the companies and support them through seed and even Series A investment later down the line. Yeah.
So it's more of a long-term approach and support to the startups.
Yeah, exactly. And it's something that is, I think, true for a number of sectors, but probably even more true for the climate tech sector, where we're talking about new models that are yet to be proven, sometimes with R&D phases and so on. So a bit, some need for a bit more patient capital, I would say, is there. And also we want to give other VCs the right message in terms of our involvement. As the name says it, we want to be catalytic with Catalyst Fund, and we want to bring other VCs to this sector. And so, we would typically be the first VC, sometimes the only VC to invest at pre-seed in some of our portfolio companies. But at seed and Series A, we want to see other VCs taking the lead and join us in this journey. But seeing us, basically double clicking and doubling down on some investments is definitely encouraging them to also invest. So that's why we continue to do it at seed and Series A at least. Yeah.
And how is the conversation with your peers, other VCs, as you mentioned? Do you manage at this stage now to have a good pool of potential partners you work with, or are you still in the phase of we need to still convince them that this is an area they need to invest in?
Now that's a great question. So we have started many years ago this thing called the Circle of Investors. So now we have, I think, more than 250 other VCs in this this group. We engage them through, we have a newsletter where we track all climate deals in Africa. We have, with some of them that have a thesis even closer to ours, we have regular touch points, on a monthly basis to share deal flow. So I would say a lot of the education work with VCs, at least, has gone a long way already. And now I think we have been able, we're not alone now, but we have been able to be at least leading an effort to put climate tech as a strong sector on the map of VC funding in Africa. But of course, there's still a lot more we can do, and we continue in this effort. But yes, we work very closely with a lot of other investors. Unfortunately or unfortunately, this sector is still small enough that we don't necessarily feel there is a competition for deals in this space. So there is a lot of room for investors to invest in that sector. It's still massively underfinanced. And so we believe in a cooperative model with other VCs, and that's what really we're trying. That's the role we're trying to play. We're happy to take the first risk, but after that, we really want other VCs who are focused on climate or not. Most of them are sector agnostic, but basically to join us on backing some of these models in climate adaptation and resilience. Yeah.
And by the way, do you see a lot of VCs having the same focus as Catalyst Fund, climate and early stage?
Climate and early stage, not so many. There are a couple, but they're not that many. What we find, and this is really reassuring, is that there are quite a few at later stage, for whom we're basically building deal flow for. And here I can name the likes of Equator VC, for instance. We have a big team in Kenya. I can name Novastar, who is also focused on climate across Africa. There's Kawisafi. So there's a number of VC funds who have this double focus on both Africa and climate. But I would say most of them are a little bit later stage. So yes, there's still a lot to be done, for sure. We need to have a lot more than 3 or 4. Yeah.
Now let's talk about the founders. So you explained your hands-on venture building, approach with them. How does this approach help early stage climate tech startups overcome the typical barrier they face?
It's, we can't put not all the startups face the exact same challenge, let's say. We can't put them all in the same bucket. But it's true that there are a number of challenges, or at least areas of challenges that are common to most startups at early stage. And this is what we try to focus on with the venture building. I can give you some example. One for sure is around fundraising. All of them are facing this challenge. And as I say, often we are the first VC fund to invest in these founders. So, it's not rare that, they're completely new to this space when we invest. So opening doors to new investors, supporting them in, rebuilding the pitch deck, building the data room, understanding the VC journey, working with them around dilution issues and so on. These are things that we do a lot. And I think what's important here to highlight is that where most typical platforms would just advise, we go and build with them. So when we work with them on the pitch deck, for instance, we don't just tell them, you should change this, you should change that. We redesign it for them. We craft those slides for them, and then they are the ones who can say, oh, actually, I would prefer it like that or like that. So we try to take as much as possible things off the plate of the founders to really reduce their workload. The same goes for things like for instance, building a data dashboard. That's something we do quite often, right? Because again, when we invest, those startups are 1 to 3 years old. A lot of what they do is Google Sheet based. It's still very analog. And we know that to scale, not in the next 6 months, but to scale in the next 6 years, they will need to build more robust infrastructure around their solution. So one thing that we do with the team is to build a data dashboard for a number of them. So again, here we have specific tools that we work with, and we basically, again, go understand the infrastructure, understand the data, and then build the data dashboard for them and support them in using them. So we co-create with them. But again, we create. It's not just advising them, hey, why don't you use this tool to create a data dashboard? Because we know that these models, unfortunately, on things that are, I would say, extremely important but not urgent, most founders, if you tell them, this is a nice tool that you should use to build a data dashboard, they will not do it. At least not now. They will wait that they have a bigger team and so on, and sometimes it will be a little bit too late. So that's why on these important things, we try to build it with them so that then they have a more robust foundation. The same goes on things like governance, putting together an advisory board. I can go the list on and on, but we try, I would say, if I have to summarize, we try to focus on supporting them on these things that are important but not necessarily urgent. We're not here, to solve day-to-day problems, but we're here to help them build the foundation so that they can raise the next round, so that they can scale to the next, $1 million revenue and so on. That's really what we focus on, building these foundations that will help them scale in the long run, and that sometimes, they don't have the space and bandwidth for. So we come in as this sort of like Swiss knife solution. And when we don't have the expertise in-house, we don't hesitate to work with partners outside, especially when it's, I would say, very expertise focused areas in climate, in the climate space, like, carbon credits, or water quality questions and so on, like things that we cannot have all the expertise across all the climate tech sector. So in those areas, sometimes we work with consultants externally or with experts externally, and we allocate budget to that. And I think that's, maybe I will finish on this last point, is that there is no silver bullet when it comes to venture building. You need to allocate time, money, and people. You can't do that on the side. It cannot be a high-level platform support with a Notion page where you put a couple of tools and they will go there and get things themselves, or like, one size fit all webinars on how to do things. These don't work, and sometimes it's even counterproductive because it takes the time from the founders without bringing the value and the support they exactly need. Our model is extremely customized. It's built around them. We're not going to support a startup on marketing if they already have a fantastic marketing team. We try to really customize our support and allocate money to each venture building support, as well as time and people. So that's why I was saying 300 to 500 hours of work. This is not an estimation high level. We're counting all these hours, and I can give you the breakdown for every single company of what number of hours was used to deliver what and what was the impact of it. We need to be extremely granular and data focused when it comes to this, so that the startups see the value, and then also build trust around what we do.
Super interesting. And I like the fact that you said co-creation. It's really like, it shows how you really work with them. It's not just giving a check and waiting for things to happen. And I guess over time you also built like a very strong system that can, as you mentioned with the dashboard, that can really support them and remove the load from their shoulders, because they are super busy. So
for sure, yeah, no, and sometimes we tend to forget how much there is on this founder's plate at the beginning. When we invest, the team is like 3 to 4 people. Sometimes it's 2 founders, sometimes it's just 1 founder. The amount of decision making falling on them is huge, and I think they really appreciate the fact that we come in and don't ask them for things, but actually offer them things. And we're like, you know what, we see that you're doing this and that. Why don't you leave it to us? And it's all kinds of things. For instance, because we're in the impact space, a lot of them apply to grant funding from various organizations. And this grant funding is extremely helpful and catalytic and so on, but sometimes applying to these grants takes a lot of time.
It's a full-time job.
Yeah, it can be a full-time job. And so, it takes time, it takes money. And so that's things that we try to do sometimes with them. We apply to these grant opportunities for them because we know the companies very well, and often we know also the organization disbursing these grants quite well. So we are well placed to apply basically on their behalf. So not only we scout and identify these opportunities for them, but also we go a step further and apply for it. So that's how we unlocked also grant funding for a number of our portfolio companies. But again, there's no magic bullet there. You need to allocate time. So
yeah, you're really supporting them. I love that. Let's talk about the solutions, the climate solutions in your portfolio. You mentioned one example, but I'd love to hear more about some of the climate solutions that are showing the strongest traction, both in impact and financial performance. If you can give us a couple of examples.
Yeah, I'll give you one. So before coming here, I was in Lagos in Nigeria, and there we have actually made a lot of investments. We have made 7 investments across the country. And so I'll give you 2 examples actually from Nigeria. One is a startup providing SMEs with access to solar energy, basically transitioning from let's say carbonated energy to solar energy, which is both a mitigation and adaptation play in that case. Mitigation, why? Because we move from diesel generator in most cases and carbonated grid to solar energy, and also resilience because it's an economic resilience in the sense that unfortunately fuel prices in Nigeria have basically gone up by a multiple of 6 in the past 2 years. So what you were paying for diesel 2 years ago, you're basically paying 6 times now. And so being able to transition to solar energy means that basically you will end up paying less on energy every month as a small business owner. And here we're talking, it can be very, very small businesses. So it's extremely, extremely important for them. So this company is called Earthbond, and they basically work with financier and also provide financing directly themselves to startups willing to transition companies willing to transition from the normal grid and diesel generator to solar. So that's one example. They're still early stage, but they already converted a few dozens of SMEs to solar energy, mainly in Lagos, but they will also look at expanding soon. Another example I can give you is a company called Zebra Crop Bank. They are in the region of Abuja in Nigeria, and what they do is they basically are building a sort of Airbnb for crop storage in the agriculture space, right? So the way it works right now in agriculture in most places, I mean, it's the case in Nigeria, but it's the case in many places in Africa, is that as soon as you harvest your production as a smallholder farmers, you basically take that production to the closest market, I would say, or even sell it to intermediaries who would come with a truck and say, look, I will buy all your production. This is the price. They pay you the end of the story, which means that farmers are basically price takers. They're not able to compare prices. They are not able to sell when they want, and so they basically are at the very bottom of the chain when it comes to food production, although they are the ones actually producing. And so that's what Zebra Crop Bank is trying to change. So they are deploying a network of crop banks where farmers can store their harvest. So it's not necessarily let's say the most perishable items. We're not talking about for instance tomatoes or mangoes, but we're talking about grains and so on that are perishable but a bit longer term. They can store them there. And they can do 2 things. One is basically decide when they want to sell, and then Zebra Crop Bank is also putting them in touch with off-takers that they can compare price from, and also increasingly they are able to use these crops stored at one of the banks as collateral to basically get some lending for it. So that's the two effect. These crop banks are now increasingly also solar powered to control the temperature and the humidity and so on to avoid that the crops go bad. and they're deploying them across the country. As you can see in this example, it's an infrastructure play, right? The way Buffy, the founder of Zebra Crop Bank, puts it is that he's building the rails for agriculture in Nigeria. This storage infrastructure is not available, and so instead of waiting for someone else to build it, they're going for it. And they are already supporting thousands of farmers across that region. So that's two examples that we are seeing, that we invested into. But yeah, I could go on and on. We have 25 companies now. So
25 in your portfolio?
Yeah, I mean 24 closed investments, and we approved recently a 25th one that is not yet closed, but it's about to be closed. Yeah.
Okay, amazing. And based on the experience, working with early stage climate tech founders, what are the common pitfalls, mistakes that you see them doing?
The first thing I would say is sometimes being too product focused, in the sense that we have come across a number of founders that build a product, refine it, improve it, keep working on it, and so on. And only once the product is, in their view, ready, they start and try to sell it. And then they realize that maybe there is no market for it, and maybe the personas they had in mind actually don't need these solutions, and so on. So being too product driven sometimes can be a problem, and thinking about thinking about the product before thinking about the problem they're solving for. I think this is a challenge that we come across sometimes. And personally, as a VC investor, I often say that I am sold at the problem level. Show me that the problem you're solving is big enough, and then I want to hear about your solution. If you start to sell me the solution before, usually there'll be something missing there. So that, I think, is an important pitfall, is making sure that you look at the problem and the personas you're tackling this problem for, in parallel of building your product.
Which is kind of counterintuitive, because, as you said, there is a lot of R&D, in that space, and it's science-based solutions. So we have people that are very I wouldn't say scientists, but very knowledgeable, in their field. So it must be hard for them to.
Being an entrepreneur is always being on a fine line between a lot of things, right? You need to be, product focused and be spending a lot of time on your product, while also looking at your market, talking with your potential customers, and understanding the market. You need to be extremely optimistic and dream big, while also being very pragmatic and making sure you drive sales on a daily basis. So you need to be on this fine line with a number of areas, and that's the challenge of being an entrepreneur, for sure. It's always having a couple of things at check. The same goes on the financial front. You need to be obsessed with driving your top line revenue, while also keeping an eye on your gross margin, right, to make sure that your unit economics continue to make sense. And all these things are always in tension. So that's for sure is a challenge. Is the case for product as well. And another, I would say, challenge that we've come across, and that's sometimes the case with early stage founders, is the fact that they might not be too aware of how the VC ecosystem works, and also then therefore make some errors when it comes to their managing the cap table. So it's not uncommon, unfortunately, to see very early stage founders who are just a year down the line. They have barely revenue, and they're already given 20-30% of equity to angel investors, for instance, or so-called accelerators. I say so-called because, in my view, when you do this, you're not accelerating anything except failure. And so I think that's a challenge we're seeing, and unfortunately, it makes the journey down the line much harder. If you just started, but you already gave away rather 20-30% of your company, things are going to be hard. So that's something that we try to support companies on avoiding at the very beginning, and we had a lot of discussions with angel investors, with other accelerators, pushing back on deals that were sometimes too aggressive. But that I think is a challenge that we see. Sometimes investors tend to forget that having a huge share in a company that will not scale is quite useless. And so it looks nice in your model because you say, okay, I have 20% and this company is going to scale X and so on. But you're missing the point that if you take 20% of the company and you have as much shares as the founders have at the beginning, it's going to make the fundraising journey very hard. And therefore, without funding, the companies will not scale. So your projections will not go the way they want it to go. So I think this is something that there is still a big gap. And here I'm not even talking about angel investors that ask for half of the cap table when they put $50,000 in the business. So that I think is something that we see as a challenge. And maybe to mention a third one, we talked about, well, fundraising is definitely a challenge. I mean, it's not even a pitfall, it's just a very big challenge throughout the journey. But I would say maybe another one is, so this comes a little bit later down the line, but it's transitioning from this time of the startup, in the startup journey, from a point where as founders you basically do everything, to a point where you start to delegate and you start to have a team, you start to have a middle management and so on. And you start, maybe you hire a CMO, you hire a COO and a CFO, and you will have to delegate to them. I think this part is hard for two reasons. One is to hire people is really hard, to hire the right talent that you can trust and that they will share the same vision you have of the company. And two is to accept to delegate, right? To accept to no longer take customers on the phone when they call, to accept to not control everything and not take all the decisions in your business. I think this is a very hard part because it's their babies, and it's really hard for a number. And we're facing this because often this problem arises after you've raised your first round of funding, right? You raised your first $1 million. This is the point where you need to hire, you need to delegate. And this is hard because we're talking about founders that have done everything themselves for the past 2-3 years, even more sometimes. So that I think is often a challenge, and this is something we try to help them on by working on job descriptions together, by hiring people, by interviewing people, and by supporting them in understanding an important point. And I will end on this when it comes to pitfalls is understand that when you raise VC money, the goal is not to live as long as possible with this money. It's not to extend the runway as long as possible and to survive for the next 3 years with this money. No, VCs invest in you as an entrepreneur so that you accelerate with this money. And that's a very important point to understand for founders in order to be able to work successfully with VCs. They don't want to extend basically the deadline of your company. They want to accelerate, to help you accelerate. So founders are often surprised when we have a call and I see their runway is basically the same as 6 months before, and they tell me, we have been very lean, we're now still at 20 months runway, and then I look at the revenue and the gross profit line, and it's still very stable as well. It hasn't grown, and I'm like, I'm okay that you keep the runway stable. If your revenue grows massively in parallel, that's fine, that's great. But if your revenue is flat, the team size is flat, your gross profit is flat, and your runway is flat, what are we doing? Why are we investing in you? I don't want you to just keep our cash. Then we should have probably put the cash somewhere else. So that I think it's a conversation that is always interesting to have the first time, because this is when they realize, okay, actually, this money is for me to burn, to accelerate, not to waste. Burning doesn't mean getting a nice fancy office and doubling your salary. It means accelerating your company scale. And that I think is another pitfall that sometimes is hard to understand. And as I told them often to many entrepreneurs, you don't need to raise VC money. You can have a great customer base. Your customers are your first investors to a lot of extent. Build a strong customer base, become profitable, and you will never need. And you will raise, maybe you will grow 5-10% per year. That's great, and that's fine. That's okay. That's a journey you can take. But if you decide to embark on the VC journey and on the VC path, then you need to understand that, one, we want you to scale fast, and second, we don't want you to basically keep the cash as a treasure and not spend it. It needs to be spent, and it needs to be spent at a certain velocity, so that then you will raise the next round and scale further. So that is maybe a last pitfall to mention.
How do you identify those that are a good fit for VC money, as you said, and those who are actually not? And they might build, as you said, very stable, good businesses, making profit and, being here for the next 10, 20 years, but they are not a good fit for VCs.
Yeah, it's a good question, and to be honest, it's not an exact science. I mean, we are wrong probably as much as we are right, or even sometimes more. So it's okay to be wrong. I think it's one thing I learned in this job is that you will miss opportunities, and you need to be okay with that. But yeah, how do we recognize companies that are VC backable than those who are not? There are a number of things, but it goes back to what I said earlier: scalability, the vision and the ambition of the founders to reach a certain size. It doesn't have to be that they all want to be a $1 billion company, but they need to still want to scale their revenue to a significant size, because otherwise for us it doesn't make sense. We want to invest in companies that can do multiples of 5, 10, 20, 30x over the period of the life of the fund. And so therefore we need companies that really have this ambition, knowing that a number of them will shut down. It means that the ones that don't need to even scale more. So have this ambition. And I think it often trickles down to the team behind the startup. I mean, I often say that, and maybe it's controversial, but I would always back a strong team with a bad product more than a fantastic product with a bad team, because we know, especially and this is true most likely only at early stage. When you do pre-seed investments, we know when we do an investment in an early stage company that is 2 to 3 years old, that there is a chance they will pivot at some point. But if the team is strong, this pivot will be a success, and eventually the company will be a success. If you have a fantastic model, but the team is a disaster, it will not go anywhere. No way. And so, that's why we spend a lot of time understanding the team. We spend a lot of time having, meetings with the entire team, the founders, of course, but the entire team as well. We try to spend time in person, even before investing, which is not always easy, looking at the number of countries we cover. But this is really important. We have this thing that we call a partners call. So it's a one-to-one call with each of the partners in the fund, with the CEO of the company only, where we talk about, of course, the company, but we talk a lot about themselves. Understand what drives them, what sacrifice have they made, what sacrifice will they do in the future, what would they do if they would not be running these companies. We need to try to understand the founder market fit as well, because, as I said, it's a lot about the team, if not entirely about the team. But if you even go a step further, it's about the CEO. At the end of the day, this is the person we're backing. We're backing a CEO. This will be the person, he or she will be the one driving the company. Co-founders sometimes can leave. It's really rare that CEO leaves, at least for the first, 5 to 10 years. And so we really want to make the right bets on these CEOs. And that's, I think, is a way to then understand whether the company is VC backable or not, is understanding whether the CEO has what it takes to to accelerate the company to the point we want it to be.
So, for VCs who want to enter the climate tech space, what advice would you give? How should we approach this category differently from traditional tech investing?
I would say two main differences with the typical VC. And when I say typical VC, I would say the way people were seeing VC as like Silicon Valley based VC, I would say even a couple of years ago, because even that is changing, is that in climate tech, and it's true in Africa, but it's true elsewhere as well. First, it's not going to be just software. We will not solve climate change and help people adapt to climate change with just mobile apps. That will not happen. And this is the case with almost our entire portfolio. And the way we call it is tech and touch, right? So there's tech, but there's also an offline, more tangible element of it. We talked about Zebra Crop Bank. Here's a good example. They have warehouses, they have teams on the ground. We could talk about Nation in Egypt that is developing containerized access to water and solar energy. They are deploying containers in remote areas. Again, they have a team, they have hardware. And this is almost the case for all our portfolio companies. So that I think is a very important thing to understand, is like it's going to be a bit, at least, of hardware, of assets, and so it's not going to be just pure software. And that's interesting because if you talk to climate tech investors in Europe and in the US now, pretty much all their backing is hardware, right? Alternative cement companies, nuclear fusion solutions, and so on. This we're talking about almost industrial kind of solutions. So it's assets heavy, it's hardware heavy, and yet it's still backed by VCs because we believe that the scale can be there. So that's the first thing. It's not going to be just software. The second thing I would say is that it doesn't. We need to understand. VC investors in that space need to understand that it will not just be VC funding that they will require in terms of assets, in types of vehicle to finance their growth. They will require VC funding, but they will also require probably some working capital that will come from maybe debt investment. They will probably require some grants to do maybe further R&D, and so on and so forth. So it's going to be an hybrid approach to financing. So that I think is the second point, and we are seeing it change already. If we talk right now, the biggest subsector in climate tech in Africa is renewable energy, solar energy mainly driven by a model that we call pay-as-you-go solar. And most of the large companies, large startups in that space, have already started to raise quite a lot of debt, for instance, which was not necessarily available at that scale, 5-10 years ago across Africa. It's now more available, and that's a great thing. But it's important that VC investors in that space understand that it will be a mix, a blended financing, not just VC. So those are, I think, two important things that I would highlight. And the third one is, at least for a number of solutions that are nature based or things like that, is that it will be a little bit more patient capital that will be required, and so maybe it will take a little bit longer. It doesn't mean that acceleration and scaling will not be there. It might just be that when you're working with solutions that are deploying agroforestry, for instance, as much as you support, and no matter how much money you put in it, plants will not grow faster. So that nature element needs to be factored in.
Amazing. I wanna talk about Africa, the big deal, because you've built one of the richest databases on African startup funding. So for those unfamiliar with Africa's ecosystem, what are the key trends they should know about?
Sure, yeah. So Africa, the big deal is something I started a couple of years ago because I couldn't find good data. It was either ridiculously expensive and bad quality. And so I started that with a friend, and now it's been 6 years. And we've built a platform that we know is being used by a lot of other VC investors, but also entrepreneurs themselves, ecosystem players, and so on. So we keep doing it. It takes a lot of time, nights and weekends, but it's super helpful and a great door openers as well to the ecosystem. So to your question on trends, there are a number of things. I mean, I think that's not necessarily specific to Africa, but we have been through a cycle, right, of what we call the funding heat wave and a funding winter. So funding heat wave was, probably basically during the end of COVID and after that, so 2021 until 2022. We had, a lot of funding going to the continent, even north of $5 billion 1 year. After that, we had, and of course, very high valuations that would come with it. It was a lot driven by fintech sector in Africa, at least. After that, we had what we call the funding winter, which is basically a market correction, valuation reducing significantly, investors being increasingly careful, less funding being deployed. We dropped to about $2 billion of total funding per year in Africa. That was 2023, 2024. Since the beginning of this year, things have started to bounce back. Again, that's at global level, but in Africa as well. And now we are on track to be at probably around $3 billion of funding in Africa this year, which is about $1 billion more than the previous year. It's still very small. Don't get me wrong. There's been more funding going to startups in Miami than the entire Africa last year. So it's still very small, but it's growing again, and that's a good news. When we double click on this $3 billion, it can be roughly broken down as a third of it going to fintech. It's still a very strong segment. But what's interesting is that behind fintech, we have a number of sectors that are growing. I mentioned energy. Renewable energy mainly, but also logistics, transportation, and so on. And then if we apply the climate tech, I would say not sector, but like cross sector filter, because climate tech, it can be fintech, it can be agri-tech, it can be transportation tech. It's quite wide at the end. A solution that does crops insurance is fintech, but it's also climate tech. A solution that does transportation with EV vehicles is transportation, but it's also clean tech or climate tech. And so the overall climate tech space in Africa right now represents also about 30%. So $1 in $3 invested in the continent goes to climate tech. And that's, I think it's the highest ratio since we started tracking data. So it's definitely encouraging and a trend that we hope will continue. So that's in terms of sector. We mentioned fintech, then there's climate tech growing. In terms of geography, that's an interesting specificity about Africa, is that more or less 80% of the funding goes to 4 markets, to 4 countries, which are Egypt, Kenya, Nigeria, and South Africa. We call them, within the ecosystem, the Big Four. And this ratio has been quite stable over the years. Some, ranging between 80 and 90% of all the funding, which means that you have a very dominating 4 markets that are absorbing most of the funding. There are markets that are growing behind them, but because these ones have a head start, I would say it's very unlikely that this domination will change. Maybe the ratio will change a little bit, but they will probably still remain ahead of the pack for a long time. And so this is why if you take any portfolio of any VC investor focused on Africa, you can be sure that most of the investments are in these 4 countries. That's our case, and that's the case for most VC investors. It also means that a lot of the 54 countries across Africa don't necessarily have startups that have raised funding rounds. So there's still many countries that haven't had a single startup raise more than $100,000 across Africa. So this is still a lot to be done in that space. But yeah, that's roughly what I can say. Maybe let me think of a 4th data point that I think is specific to the continent. maybe, I mean, it's not specific to the continent, unfortunately, but this is a bit of a sad statistic, is the percentage of funding that goes to startups with a female CEO. I think we are at less than 2% across the continent.
Isn't it the same globally?
It's more or less the same globally, and that's the problem. The sad point, though, is that it's been decreasing in Africa. So it used to be more. It's now the lowest it's ever been. And so in our view at Catalyst Fund, and here I take back my Catalyst Fund hat, a way to change this, at least for some time, is that investors, in agreement with their LPs, and I think LPs should actually drive this, especially large DFIs, I would say, that are funding most of the VC funds in Africa, should drive this, is to impose investors to have a certain ratio of female founders or co-founders in their portfolio. At Catalyst Fund, we have set this target for ourselves, and then we have embarked our LPs with us on this journey, and this target is at 40%. So we want 40% of our portfolio of companies to have at least one co-founder who is a female. Right now we are a little bit over 30%, so we're still, I would say, on track. And this is way above the ratio of the ecosystem, but we believe we have a duty as investors to drive this change, because it will not come organically. We cannot just hope for this to change. We need to take actions, and unfortunately, I mean, it's not a pipeline problem, right? I mean, yes, there is maybe less female entrepreneurs than male entrepreneurs if you take the absolute numbers, but it's not in these proportions, right? And actually, when you look at the pipeline, at pre-seed, seed, Series A, Series B, at pre-seed you have a ratio of female founders that is, I think, somewhere between 20 and 25% of the funding that goes to them. At Series A, Series B, and beyond, it drops to almost nothing. This is the problem we have. It's basically the conversion of female-led startups through the different rounds. So it's not a pipeline problem. That's my main point, is that it's, in my view, mainly an investor problem. And as investors, we need to take actions there, because we're seeing how hard it is for female-led startups to raise. We have amazing female-led startups in our portfolio. We are seeing that despite the fantastic metrics that they have and huge growth and so on, they're having it much harder to fundraise than their male counterparts. It has nothing to do with their company. It has nothing to do with their model, with the country they are in, and so on. It has all to do with the gender, and that's an issue. So we are seeing the types of questions they get. We are seeing the types of due diligence they get from investors is not the same as male, and that's the challenge that we need to address. So yeah, long story short, at Catalyst Fund we're taking actions about that. Being a female-led fund, because my partner in the fund, Maëlys, who is the managing partner, is a woman, and so we want to make sure that at least we're supporting a change in that perspective.
Yeah, glad to hear you voicing this problem. Let's end this episode, Maxime, by a quickfire Q&A. Number one piece of advice to a climate tech founder.
One piece of advice for climate tech founders in Africa: keep your vision and your dream target as big as possible, so that you can always chase it.
To Africa in one word.
Diversity.
Accelerator or venture studio?
Accelerator.
One reason VCs should focus on climate.
Because it's by a significant margin the biggest problem we're facing right now.
One thing you want to see changing in the VC world.
Not diverse enough.
And one startup that truly inspires you right now.
I'll give you one that is a female-led startup. It's called Farm to Feed in Kenya.
Super. Thank you so much, Maxime. I mean, that was such a insightful, a lot of learnings from this conversation. Thanks for coming on Impact Talk.
Thank you.
Thanks for tuning into until the end. So if you like my conversation with Maxime Bayen, please don't forget to subscribe and leave us a review. We're on YouTube and all the podcast platforms. And see you at the next episode.